Today, the end game approaches. Hello again, it's Martin North from Digital Finance Analytics, where latest posts covering finance and property news with a distinctively Australian flavour. Well, things are continuing to work their way out. And in fact, the market gyrations this week may be giving us some clues as to the uncertainties ahead. Well, the S&P 500 fell for the second week in a row on Friday as the rotation from growth to so-called value stocks continued, keeping tech stocks and the broader market in check. The S&P 500 fell 0.1%. The Dow Jones Industrial Average rose 0.37% and the Nasdaq Composite slipped 0.48%. Investors have bet that value sectors of the market will continue to outperform growth, and that, of course, is including momentum in the economy, which is pushing financials, energy and industrials higher, except some of those metrics do look a bit wobbly. Financials were the best performing sector on the day, with banks including Morgan Stanley and Goldman Sachs rising. There was a climb in Boeing, which lifted the industrials higher, based on reports that the aircraft maker is mulling ramping up output of its 737 MAX jets to as many as 42 jets per month by late next year. Energy, meanwhile, was helped by a rebound in oil prices from weakness seen earlier in the week, even as investors fear a wave of Iranian supply is on the horizon as the Islamic Republic inches closer to a nuclear deal. The economic backdrop continues to support investors betting on a stronger recovery as manufacturing and services activity, a key driver of the economic engine, do continue to improve, but remember the base effect. Tech stocks, meanwhile, shed gains as growth stocks struggled to find their footing, though managed to avoid a fifth straight week of losses. Apple, Microsoft, the Google parent Alphabet, Amazon.com and Facebook all ended in the red. Apple was under further scrutiny after the CEO Tim Cook took the stand for questioning over the company's App Store business model amid an ongoing legal battle with Epic Games. Chip stocks were flat after a strong week of gains, although Nvidia was up 3% after announcing a 4-to-1 stock split that will need to be backed by shareholders, and Intel was up 0.23%. The Federal Reserve minutes for its April meeting showed that some Fed members were starting to think about tapering bond purchases. The market largely took the comments in their stride, actually, as confidence that the Fed will be able to lay the ground for a tapering without the tantrum or sell-off in risks seen previously, but that, of course, may be overestimated. It was actually healthy for the market, the Fed comments on tapering, that is, said David Wagner, portfolio manager at Aptus Capital Advisors. This instills faith in the market that the FOMC is not completely dovish and that they can be hawkish, which is a positive from an inflationary perspective. The idea of temporary inflation seems to be creeping into the minds of the financial community, helping to calm interest in commodities. And furthermore, we see politicians in different parts of the world engaging in their ways to combat the inflation threat. China, for example, announced measures earlier in the week to curb metal prices, quickly cooling the recent overheating. Oil's growth trend is again in question. Top policymakers say that the nuclear talks with Iran are productive, so they could lift sanctions prohibiting Iranian oil exports, and this may increase the oil supply, putting pressure on the price in the downward direction. And Bloomberg also says that pro-inflationary trends are pausing, noting a drop in demand for lumber and house building amid multiple price hikes. At the same time, sawmills are not increasing their production, suggesting the recent boom is indeed temporary. So maybe all of these issues are more to do with temporary stuff rather than structural inflationary stuff, which then does suggest that maybe deflation is still a valid argument. Moreover, the Philadelphia Fed Business Activity Index fell from a record 50.2 in April to 31.5, much stronger than forecast. At the same time, the US 10-year government bond yield went down and inflation expectations from the markets cooled, indicating a decline in interest in inflation-tolerant bonds. Lower inflation fears potentially mean stronger support for growth versus value stocks, providing an advantage maybe for the Nasdaq over the Dow Jones in the weeks ahead. But again, we will see. And by the way, don't mention the repo activity because that is now much higher than it has been, and that suggests more wobbles in the deep financial system plumbing. Meanwhile, in Washington, news broke that the White House has scaled down the size of its infrastructure stimulus package to $1.7 trillion from a mere $2.25 trillion ahead of President Joe Biden's meeting with Senate Republicans, who are wary of further spending. But remember, the proposal is still far off the GOP's counteroffer of $568 million. US Treasuries continue to retreat as demand for Thursday's auction for 10-year Treasury inflation-protected securities disappointed. The demand also indicated waning confidence in the US Federal Reserve's insistence that any inflation is likely to be temporary. The minutes from the Fed's last meeting, released of course on Wednesday, hinted that debate on scaling back unprecedented stimulus to support the economy through COVID-19 did take place, despite the fact that Powell said they're not even talking about winding it back. US initial jobless claims dropped to their lowest levels since March 2020, with 440,000 claims filed during the previous week. Some investors warned that the road towards economic recovery from COVID-19 remains long. While inflation has been the star of the show, keep in mind that the Fed's mandate is twofold, with employment as the other side. The jobless claims read shows once again that we're heading in the right direction, but we've a way to go from where we were pre-COVID-19, E-Trade Financial Managing Director of Investment Strategy Mike Landgraf said. However, other investors struck a more optimistic note. Overall, we're still quite risk-on, UBS Chief Investment Officer, Head of Global Asset Allocation Adrian Zurcher said. COVID-19 vaccine rollout and reopening up of the economy should lead to higher equity markets, and that the reflation trade is not yet over, he added. But elsewhere, existing home sales declined yet again as a result of low inventory of properties for sale and rising prices keeping buyers at bay. Existing home sales fell 2.7% to a seasonally adjusted annual rate of 5.85 million in April, according to the National Association of Realtors. It was the third consecutive month in home sales falls. Compared with April 2020, home sales, though, are up nearly 34%, though the year-over-year comparisons are once again skewed by the onset of the COVID-19 pandemic in the early months of last year, the base effect once again. Home sales were down again in April from the prior month as housing supply continues to fall short of demand. Lawrence Yuan, chief economist at the National Association of Realtors, said in the report. We'll see more inventory come to the market later this year as further COVID-19 vaccinations are administered and potential home sellers become more comfortable with listing and showing their homes, he said, adding that the declining number of homes in forbearance would also help matters. The Midwest was the only region to see sales growth between March and April, up with a 0.8% uptick. The Northeast had the biggest decline with a 3.9% drop in sales. The overall decline in sales was caused by a 3.2% drop in single-family home sales, whereas the sales of condominiums and co-ops rose 1.4% from March. The median existing home price in April was $341,600. That's a new record high that represents a 19.1% increase from a year before. But of course, that is just chicken feed compared to the stupid prices that we have in property in Australia. Properties stayed on the market for 17 days in April on average, and 88% of homes sold last month were on the market for less than a month. More startling, though, is the difference in momentum in sales at the most expensive levels compared with the lower priced property. The unequal effect absolutely continues. There were signs of improving inventory conditions, though. Unsold inventory was at a 2.4 month supply in April, up from 2.1 month supply a month earlier. Most economists argue that one of the biggest factors holding back the housing market right now is the lack of inventory. Unfortunately for everyone in the housing market, from home buyers to real estate agents to mortgage lenders, it could take years to rectify the situation. A new analysis from title insurer First American Financial Corp examined the great housing supply crash of the past year and explained how it was really years in the making. A lot of Americans who already own homes opted not to sell them this past year, in many cases because of concerns relating to the pandemic. As these homeowners start to warm to the idea of selling now that COVID-19 cases are down and vaccines are readily available, that should reduce some of the pressure, but it won't solve everything, they said. Inventory turnover, the supply of homes for sale nationwide as a percentage of occupied residential inventory, was low even prior to the pandemic, but dropped precipitously last spring. First American chief economist Mark Fleming wrote in the report, plus years of underbuilding means that America in general doesn't have enough housing to go around. The old supply issue again. I'm very sceptical of that, as you know. To truly get supply and demand back in sync, it will take years of accelerated new home construction, Fleming wrote, adding that an end to the pandemic in itself is unlikely to bring enough sellers to the market to bridge the gap. Despite some still strong demand for more houses, amid the work-from-home trend, inventories remain extremely lean. Pending home sales have wilted and new mortgage applications have slowed, suggesting activity has somewhat been capped as home prices surge and mortgage rates creep higher. Overall, while the housing market is likely to remain sturdy, we expect momentum to ease by the end of the year. Priscilla Thamungi, an economist with BMO Capital Markets, wrote in a research note, even if a bit wary of the conditions they face in today's markets, buyers remain eager, which has resulted in quick home sales and at record prices, said Danielle Hale, chief economist at Realtor.com. Meanwhile, rising seller sentiment could mean some relief is ahead and perhaps even a greater than normal share of homeowners stepping into the market later this year. She added, while it's not enough to end the shortage of homes for sale, this wave of sellers will make a dent, giving home buyers more options to choose from, Hale said. Fewer than 1 million existing single-family homes are now in the market, less than half the 2 million low at the peak of the boom in 2005. As supply starts to rise, the recent explosive increase of rates of home prices probably will slow. Ian Shepherdson, chief economist at Pantheon Macroeconomics, wrote in a research note. And investors also focused their attention on US President Joe Biden's tax agenda as the Treasury Department unveiled details of a proposal to raise $700 billion in additional revenue over the next 10 years. The funds will be raised via Internal Revenue Service enforcement, with cryptocurrency transfers worth more than $10,000 to be reported to tax authorities. The US also separately called for a global minimum corporate tax rate of at least 15%. Which takes us to Bitcoin, which is heading into the weekend in free fall again after fresh warnings from Chinese officials over cracking down on cryptocurrencies. The largest digital currency fell as much as 10% late on Friday to a low of around $35,000, and peer tokens also posted double-digit losses. The coin almost hit $30,000 earlier in the week after ending May the 14th at $49,100. The latest blow came from China's State Council, who reiterated its call to curtail Bitcoin mining and trading. The crypto market was already rattled earlier in the week by forced selling and possible US tax consequences. Friday's sell-off hit Bitcoin believers still fuming after one-time proponent Elon Musk did an about-face and criticised the tokens for its energy use. Bitcoin is already down more than 25% since last Friday, though it's up from that Wednesday plunge of $30,000. Other coins have slumped too. Ether is down by 38% over the past 7 sessions. The sour stretch started with Musk suspending acceptance of Bitcoin payments at Tesla and trading barbs with boosters of the cryptocurrency on Twitter. China's central bank added to the downdraft on Tuesday with a statement warning against using virtual currencies, and on Thursday it emerged the US may require crypto transactions of $10,000 or more to be reported to tax authorities. China has long expressed displeasure with the anonymity provided by Bitcoin and other crypto tokens and warned earlier that financial institutions weren't allowed to accept it for payment. The country is home to a large concentration of the world's crypto miners who require massive amounts of power and thus run afoul of the nation's efforts to curb greenhouse gas emissions. The new guidance issued from the regulatory agencies, they're taking it more seriously. They want more enforcement. Bobby Lee, founder and chief executive officer of crypto storage provider Ballot, said, "There's talk about going after miners. The question is, can they catch them all?" China's moves this week highlight the country's continued desire to seek control over the notoriously volatile asset class. It's something China would rather see regulated by the People's Bank of China. It's not really the mining issue that is the problem, though, said Matt Manley, chief market strategist at Miller Tabak & Co. They say they're doing this as part of an effort to control risk-taking in their markets, but it's really a signal that China is not going to be a big market for cryptos unless it's a PBOC-controlled one. And in the meantime, volatility in Bitcoin is likely to stay elevated. The sell-off on Friday once again pushed Bitcoin below its average price over the past 200 days, which to some chartists at least and technical analysts suggest it could trend lower still to around $30,000 where it found support earlier this week. This week's swings have led to huge liquidations by leveraged investors and damaged the narrative that cryptocurrencies will become more stable as the sector matures. Musk's action shows just how a few tweets can still upend the entire market. But even more so, the past few days have renewed the regulatory threat on the crypto market. Investors are understanding the regulatory risk on cryptos as governments defend their lucrative monopolies over currency, said Jay Hatfield, Chief Executive Officer at Infrastructure Capital Advisors in New York. And in the US, the possible imposition of transaction reporting requirements could be the tip of the iceberg of potential Treasury rules on virtual currencies, he said. You must always proceed cautiously with China. Never get too bullish or bearish, said David Twile, president of ProChain Capital. We'll have to see what the regulation brings. It's one thing to say, it's another to do. And this, by the way, is what Jerome Powell has recently said about cryptocurrencies. Crypto assets are highly volatile and therefore not useful as a store of value. They're not backed by anything. It's a speculative asset that is essentially a substitute for gold rather than for the dollar. Others echo Powell's remarks, claiming that Bitcoin is in fact displacing gold as an inflation hedge, or that it could supplant gold as a safe haven asset. But the question is, of course, are they right? Well, of course, there are some similarities between Bitcoin and gold that make these two asset substitutes to some extent. It would be surprising if that wasn't the case, given the fact that Bitcoin's system was designed to mimic the gold standard. In particular, there is a cap on the number of Bitcoins to make this cryptocurrency rare, just like the yellow metal. In other words, the idea is to make its supply inflexible, just as, or even more, as in the gold standard. So both Bitcoin and gold are anti-inflationary currencies whose supply cannot be arbitrarily changed like it is in the case of national fiat currencies. And both these assets have a libertarian anti-government flavour in the sense that demand for them stems from the lack of confidence in the government monies. However, there are some important differences between Bitcoin and gold. First, Bitcoin is believed to be an alternative anti-fiat asset. It's actually also fiat money. It's a private, decentralized, non-governmental currency. And it doesn't change the fact that Bitcoin is not backed by anything. It does not have any intrinsic value. Of course, value is subjective, but gold has some non-monetary use, like in jewelry and technology, which implies that its price is not likely to drop to zero in a worst-case scenario, in which people cease to see gold as a monetary asset. Unlike the shiny metal, Bitcoin has only monetary value. You can't use it as either a consumer good or as an input to a production process, so there's no floor below its price. If the officials try to ban Bitcoin, its price would plunge really deeply. Second, Bitcoin is much more volatile than gold. Sure, it might be just a problem of Bitcoin's young age, but it doesn't change the fact that price declines in the cryptocurrency are a few times bigger than in the gold market. Hence, although thanks to the network effects and speculative appeal, Bitcoin offers potential for quick and larger gains due to the volatility, it's also associated with higher downward risks. It is frankly trading volatility, that's all. It makes the cryptocurrency an inferior store of value and therefore an inferior safe haven. So Bitcoin can be seen rather as a risky asset, not necessarily a safe haven, that goes up together with risk appetite. This may explain the recent divergence in cryptocurrencies and gold. So what does all this mean for the gold market then? Well, it's true that some money has flowed from gold into Bitcoin, and that some investors may prefer now to treat Bitcoin as a major alternative asset to their investment portfolios. However, such flows and rebalancing of portfolios, as we've seen recently, are perfectly normal, especially given that Bitcoin is still benefiting from the network effects, i.e. the accelerating institutional interest and mainstream acceptance, particularly perhaps among some younger and less experienced investors. During yesterday's trading sessions, we saw more or less the repeat of the previous day's indication. Gold stocks reversed once again, and gold is trading where it was trading 2 days ago. Silver is already trading lower too. On Wednesday, gold miners reversed in a classically bearish way, and yesterday's low volume session, which was a reversal as well, looks like Wednesday's reversal's shadow. The Van Eyck Vectors Gold Miners ETF first tried to rally to new highs, but then it failed to hold them. Wednesday's reversal took place on big volumes, which is an important bearish confirmation, and the shadow reversal took place on relatively low volumes. The low volumes don't confirm the reversal, but it does more or less invalidate the seemingly bullish fact that miners closed yesterday's sessions higher. Moreover, note that the volume was similarly low to what we saw back in January 2021, when the 4-day top was ending. Yesterday was the 4th day that it appears to be a broad top. And let's also keep in mind that the RSI indicator just moved back below 70 after being above it. This happens rarely, and when it happened previously in the past 1.5 years, it meant that those huge price declines followed. Silver reversed in a different manner. The white metal didn't move to new highs yesterday, it moved lower, and then it only recovered intraday declines without moving visibly higher. Silver futures ended the day only 4 cents higher. The true reversal happened on Tuesday, and what we saw yesterday and on Wednesday was just its consequences. It's quite often the case that the tops and bottoms in the precious metals markets do take place more or less simultaneously, but not necessarily exactly on the same day. Consequently, what we saw this week is quite normal. Gold didn't manage to move into new intraday highs yesterday. However, it didn't decline visibly either. It moved a bit lower on today's pre-market trading, and overall it's just $8 higher than it was at the end of Tuesday's session. This might seem positive given that gold managed to hold slightly above its declining medium-term resistance lines, but given what's happening in the mining stocks and all the signals from them, I doubt this breakout will really hold. And there's another reason. The Fed is attempting to control the long-term rates, and we just saw a short-term exodus from the cryptocurrency market. Theoretically, capital should be flowing into gold as a safe haven inflation hedge asset, and it should be soaring, but it's not. It did move higher recently, but compared to what should happened given the importance of the above-mentioned developments, the reaction is barely noticeable. Indeed, gold seems to be insisting on repeating to some extent its 2012 performance and, to some extent at least, its 2008 performance. Either way, it seems that gold is about to slide. The reversal in gold took place after gold moved up very close to its mid-January highs, and the 50% Fibonacci retracement based on the August 2020 to March 21 decline. The size of the current rally, taking the 2nd March bottom as the starting point, and the rally that ended at the beginning of this year are practically identical at the moment. Just as the rallies from 2012 were almost identical, the same could happen now. The March 2021 low formed well below the previous low, but as far as other things are concerned, the current situation is similar to what happened in 2012. The relatively broad bottom with higher lows is what preceded both final short-term rallies, the current one and the 2012 one. Their shape, as well as the shape of the decline that preceded these broad bottoms, is very similar. In both cases, the preceding decline has some back and forth trading in the middle, and the final rally picked up pace before breaking above the initial short-term high. Interestingly, the 2012 rally ended in huge volumes, which is exactly what we saw on May the 19th this year. What is even more interesting is that back in 2013, gold started its gargantuan slide from around $1,800 and is not far from that long-term point today. And let's just keep in mind that the RSI indicator just topped slightly over 70, which is what it tends to happen when gold tops. The upside seems very limited. In fact, it seems that the top in gold might already be in. In fact, there are some correlations between the US dollar index and the general stock market, and if you compare that with what happened in 2012, and in short, the US dollar index bottomed, then the general stock market topped. Gold probably has a decent future, but it's likely to be a grinding, plodding one, and unlikely to attract any attention from the younger crowd who've become absolutely morphine addicted to the rat-a-tat action of GameStop and crypto. Now, of course, investing is something solid and reliable that is slow and steady, that hacks its way up over time. It isn't going to necessarily turn these investors on. And with that in mind, join us on Tuesday when Damien Klassen from Nucleus Wealth and I talk about what I call certainty investing. And here's a question for you. What have the Ford Motor Company, Airbnb, Spotify, Twitter, and Coinbase Global all have in common? The answer is all these companies have issued convertible bonds since the pandemic hit. Coinbase, which was down this week, that's the largest Euro crypto platform, of course, made a splash with its $1.25 billion debt issuance, which came in on the heels of its direct listing about a month back on NASDAQ. Investors snapped up the bonds, which pays a modest 0.5% rate of interest and comes due in June 2026 unless they convert to stock, are redeemed or repurchased. Conveniently issued before the last crypto rout, I might highlight too. We've chosen to issue convertible notes as we believe doing so offers a low total cost of capital, operating flexibility, and minimal dilution for shareholders, Coinbase said in a post on the 19th of March. The appeal of convertibles like meme stocks or buzzy companies yet to turn a profit is the chance to make a haul if shares eventually skyrocket. The bonds also come without the downside risk of owning those stocks until that happens. Surging issuance also means it's now possible to get a taste of the crypto world and align on far more different kinds of companies through convertible bonds after a blistering $143.7 billion came to the market since the onset of the pandemic in March 2020, according to Dealogic. The way to think of it, said Columbia Threadneedle's David King, is the now roughly $400 billion sector is it's like a Las Vegas wedding chapel. It can really run the gambit. Convertible issuance is done by every imaginable type of company, said King, adding that since his start in the 1980s, he's pretty much seen it all. There are typical reasons, which would be a company experiencing rapid or unexpected growth, he said, or firms considering a merger or acquisition. You're also seeing Robin Hoodish type companies do convertibles. Last year, a string of deals came from cruise lines and other hard-hit sectors, including AMC Entertainment, which were lumped under the umbrella of needing rescue capital during the pandemic. Those financings provided quick cash infusions to tide companies over, but also significant payouts for convertible debt holders, where rallying equities triggered conversions into stock. Convertible bonds aren't the biggest part of the debt market, nor are they easy for everyone to buy like individual stocks, but then individuals can get exposure through exchange-traded funds dedicated to the sector, such as, for example, the iShares Convertible Bond ETF. Fixed income returns have remained low for quite a while, even before the Federal Reserve cut policy rates to near zero last year and restarted its bond buying program. But our market is a very unruly market, King said, underscoring that while only about 40% of the market's bonds actually convert by hitting their target price, bond defaults also have been low in the 1.5% range. It's a lot lower than people might think, he said, of the defaults. It's also well below a classic high-yield bond. Now, quickly across Asia-Pacific, stocks were mostly lower across the week, but they were up on Friday as the economic outlook improved and investors' fears of a decrease in US stimulus eased. Japan's Nikkei was up 0.78% to 28,317. The National Core Consumer Price Index for April contracted by a better-than-expected 0.1% year-over-year in April, while the 0.4% contraction of the national CPI month-on-month was larger than the previous month's 0.2% growth, according to data released over the day. China's Shanghai Composite fell 0.58% to 3,486. And in Australia, the ASX 200 inched up 0.15%, with retail sales data for April released by the ABS showing a rise of 1.1% in April 21, following a rise of 1.3% in March. The rises were led by food retailing, up 1.5%, following falls in February and March. Cafes, restaurants and takeaway food services were 2.5% higher, with New South Wales especially strong. And across the states, New South Wales and Victoria saw rises of 2%, with turnover rising in all industries except for departmental stores. Through the year, sales rose 25.1% in April 21 compared to April 2020, following a 2.2% annual rise in March. This change, of course, reflects COVID-19 restrictions in April 2020, which led to a large fall in retail turnover that month. And once again, we see the base effect in action. It's a fairly meaningless number. So in closing, the thing I want to stress is that the markets are still relatively wobbly. There are still many uncertainties, and more people, I think, are beginning to perhaps question whether that strategic inflation is a live discussion to be had for now. And there are still deflationary signs around, and there are still potential issues. And whether you look at stocks, whether you look at gold or silver, or whether you look at cryptos, well, they're all looking a bit wobbly at the moment. And more people are now beginning to suggest that maybe the stock markets are due for some correction, and quite soon. So my observation is this. It looks to me as though we're moving towards the end game. And that end game could play out in a number of ways, and I'll probably explore that in a future post, whether that's a great reset, whether that's continued quantitative easing, or whether the taperings come through. None of those necessarily will be good for stocks, which are frankly overvalued. And if people are coming back to fundamental value rather than just sentiment, then maybe there's a need to see stocks correct too. So I would just simply say be cautious, go careful, and look for those areas where there is still more certainty rather than speculative upside, because frankly at the moment speculative upside is pretty much done its day. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.